This month, we have Steve Iskander with Intrepid, and he's going to talk to us about the capital stack. I'm super excited to hear this. They have, well, I'm not going to pre-announce his announcements, but they have some really interesting new things to tell us about. And for entrepreneurs and small business operators, trying to understand the capital stack can be really challenging, and he is here to demystify that and show us how we can all get access to more capital. So, Steve, thank you.
All right. Welcome, everybody. Thanks for joining for lunch today. So, as Ashley said, Steve Iskander, I'm the founder and CEO of Intrepid Finance, and probably a lot like you guys, started a company with just some crazy idea and started rolling with it. And before we start, real quick, understanding kind of the lay of the land in the room, how many companies are more than 3 years old in the room? Any 1, 2, 3 years old? What about from a service-based company to product or distribution? Service-based companies, tech companies in the room? Okay, a lot of tech companies in the room. Much like you guys, I started out kind of with a crazy idea, one-man band. Started this kind of as a hobby and really move into what got me where we are today, how I moved from a hobby into, I say, a very legitimate business. I'd spent 15 years, probably like a lot of you guys, in the industry that I was trying to solve. I spent 15 years in transportation finance, doing debt capital raises for companies, big companies, the big publicly held companies that don't go to the bank to get funding. I thought I had everything right. I got the big company name on my resume. I went and got my master's. I went and got my MBA. I went and launched a company. And I pitched and pitched and pitched like everybody probably in this room here has pitched before for capital. Right? You went out and did the venture raise, or you went out and tried to get some institutional capital, and I did it. I got on the road show. I thought I was a professional at pitching. I mean, literally dancing across stage, singing for supper, whatever you want to call it. And I've actually never raised $1 in my life. That's how bad I suck at pitching. So, or how bad the system is broken. And I thought, man, I'm sitting there thinking there's got to be an easier way to access capital as an early stage founder that has a business, has an idea, and has customers. I mean, there's got to be a better way, because every moment that I'm up on stage, tap dancing across the stage, trying to beg people to give me capital, going to a bank, applying just to hear 30 or 60 days later that I don't have X, which is completely opposite of what the other bank down the street told me that I had that they liked, which is completely opposite of what the other bank told me 30 or 60 days ago that I didn't like. And that's what just kept happening to me over and over again. I kept pitching. I went to the banks that I did business with prior and said, hey man, we did a lot of business together. This is a relationship business. You should do business with me and you should give me capital. And I've got the credentials and all the things that you want. And I never could get any money from anybody. Nobody gave me any money, honest to God. Like, it was pretty heartfelt. But again, I went back to if I spent this much time chasing capital as I did on my business, which is what I do best, I wouldn't need your money anymore. And it's kind of trying to flip that on man, I'm sitting here, I'm buying my pitch decks for $5,000. I don't have $5,000 to put a pitch deck together. You know, I got a lot of other things to do. I don't have 2 to 3 hours a day rehearsing for pitches, trying to find investors, getting the next warm handshake. If I was so good at pitching, I would pitch for a living and go raise capital for funds. And the same thing holds true to each one of you guys. Right? If you're so good at pitching for capital, you would just do it for a living. I would hire you because clearly I can't pitch. But you're not. You're an operator. You're the dreamer, the visionary of your organization to say, okay, here, I'm going to try to get this organization from here to there. And that's what you do really well, and it's not pitching capital. So I thought, hey, there's got to be an easier way. That easier way slowly turned in from a hobby of trying to provide capital using my, quote, Rolodex, for those in the room that are old enough to know what a Rolodex is, of the I know a guy, and saying there's got to be an easier way. We have bootstrapped the company, which is one of the forms of capital we're chat about. We've bootstrapped the company in 2025. We funded, or really rolling 12 months, we've funded $950 million in businesses. Many businesses are 3 years less 3 years old or newer. Most check sizes are about $150,000, so you can kind of do the math on the deal flow that's moving through there. We're talking early stage companies that just need an inch. They don't need a mile. And when we think about it, the different forms, as we get into the different capital stacks, there's really two kinds of capital that I look at: the offensive and the defensive. And both of those can trip you up in there. You can need offensive money and get into the wrong predatory capital, if that's VC, private equity, MCA, cash advances, whatever it might be. And that offense will throw you into defense. And if you're in defense mode and you take predatory capital, whatever form that might be, it will forever forbid you and prevent you from getting into playing offense, because now you're on the rat race. You're trying to chase your next merchant cash advance, or you're trying to catch your next venture capital raise and trying to get those benchmarks. And you're actually on the defense mode. You're no longer on the offense, and you're no longer trying to grow. You're just trying to outrun the boogeyman, which are the covenants that are in your venture debt stack, or your loan, or your covenants that are in the bank statement, in your bank loan, right? Now, somehow, magical way, you took offensive money and flipped it into defense. You went defensive on it because you're trying to, again, outrun the boogeyman on it. And these 2 points are kind of important, because you can see when we get through the capital stack how offense money can trip you up and turn you into defense mode and never get you out of that spiral, and how you can use defense capital to actually move back into playing offense and focusing on your growth. We kind of say, okay, here, what is a capital stack? It's about picking not necessarily one tool, but a system and a group of components of different services of financial tools to build your capital stack. So as many of you guys said, you're a dev company. Think of your dev stack, right? It has all the different software, all the frameworks in there, SQL, whatever. It's all in that capital stack, or in that tech stack that you have. It's the same thing that goes through your capital stack. We're not here to push one form of capital on you. It's the right capital at the right time. There's times that you should take venture capital, private equity, a credit card. You should sell your little tootsies on OnlyFans, whatever it is. There's a time that, just making sure you guys are paying attention. But it is, right? Every type of capital has a time and a place, or really none at all. We're going through kind of some of the easier ways to get financing as an early stage company without pitching. We'll go through things like revenue-based financing. What is it? Tax credits and grants. Everybody talks about it. Nobody ever applies. No one ever figures out how to get these mysterious grants or tax credits out there. Institutional, when should you move into an institution? What are the things that you can do early to move into an institutional capital when you don't qualify because you're that one-year business, or you're that business that only has $100,000 in revenue? What are the things that you're able to do today to start positioning yourself to move into institutional capital, which is typically your least expensive form of capital? And then the platform, like I said, even the OnlyFans and crowdfunding, when do you go to the platforms like these? And I kind of say, hey, these are 2 of my, I say favorite quotes on here, that they run into the fundraising trap, believing that money automatically means growth. That means you're just throwing away money, and that's oftentimes what venture, in my opinion, looks like. They're throwing away capital at a faster time, saying, I'm going to grow and I'm going to outscale this faster than I'm going to, as I burn kind of through that capital side of it. I even look at it at Intrepid. We would not be here today if we took venture capital, because I would have accelerated at a much faster pace down the wrong path multiple times. That would have tripped me up in venture had I taken venture, right? Now you get into down rounds and priorities. I'm back on the right. I got to tap dance across stage to go get more capital. All that venture capital would have done, looking in hindsight, was accelerated me so much faster down the wrong paths. Where sometimes it's okay to go slow and say, okay, hey, we're picking up our pace. We are going in the right direction. We have a modest burn. We're being frugal and agile on the way that we go. But as soon as that money comes in, everybody thinks, hey, things should continue to grow. And I say the venture capital is much like a marriage. True statistic, venture capital injection in your company is longer than, most of those are longer than the average marriage today. But you do less vetting for your venture capital than you do for your spouse, right? You dated your spouse for 6 months, 6 years, whatever it might be before you got married. You dated the first VC that would probably write you a check, is typically how it works. Of which those are typically last longer than your marriage is going to. Don't shoot me, just statistics. And we get into, we're chat through each one of these non-dilutive forms of capital on what they are and how nearly any business can use this. No matter the stage that you're in, I'm going to give you an example. If you're a brand new company to if you're a senior company. We've financed largest deal, 80 million, smallest deal, 5,000 coming through our company. They give you an idea, any type of company. And it's the way that I think of it as what is the true asset. So we're kind of flipped through each one of these. Of course, you've probably recognized names on there. Don't really know how to use these in your current company, but we'll go through each one. Accounts receivable or accounts receivable financing, right? A lot of them think of it as point of sale machines, merchant cash advance sides of it. But accounts receivable are taking those revenues that you already have or your future revenues that you already have. So let me give you an example. That SaaS contract that you signed for $1,000 a month for 12 months, the consulting agreement that you signed for your cybersecurity side of it, that agreement has value. They signed $1,000 a month for 12 months. That agreement's worth $12,000. Congratulations. Banks may not see it like that. Your venture capital might not see it like that, but it is truly a collateralizable piece of paper that you can turn into capital to fund your business. That's your order. That is worth capital. There are institutions out there. We work with over 150 institutions that will buy that piece of paper from you. Typically at less of a rate than you could have gotten it from an interest rate if you were to be able to go qualify for a loan hypothetically. That piece of paper. So we focus a lot on saying, just go grow at all costs. I say that kind of loosely, but keep growing. Every one of those orders is worth money. And you can take that and turn it into liquidity instantly without giving it equity in your organization. So think of it as your accounts payable is that agreement. I've got a customer, now I just need money to fulfill this agreement. Venture often is, I have some customers, or if I build it, they will come, right? If you think about it. Institutional or revenue-based financing, or a lot of these are, they've already come, but now I need the money to fulfill my agreement, which is often the conundrum for a lot of the companies out there. Asset-based loans, which kind of blurs into the AR. AR is looked at as its own asset, but asset-based loans, I look at some of the asset-based loans a little bit differently because it could be inventory financing that you can do. So if you're looking from, you're a B2C company, you're an Amazon distributor, you can use that as truly part of your asset base to be able to go get it. So maybe that bank won't give you a $150,000 loan, but a PO financer or an inventory financer would give you $150,000 to hold, to finance that equity, or to finance that. If it's protein for your powder milkshakes, if it's lipstick, your purses that you're distributing, they will hold that where a bank wouldn't give you that money. So there are specialty lenders out there that will hold your PO and inventory financing for you out there as well. That is part of the asset. So we're going specifically into those saying, you don't need $150,000, which is often, right? You go beg the bank for 150 grand, you go beg the VC for 150 grand. You need $150,000 of a specific product. And your odds dramatically increase when you go after specific products, not just a loan. In this case, it went after inventory financing. Invoice factoring is when you sell off your invoice. So now you've invoiced the client. You said, hey, Mr. Customer, you owe me money in 30 days, 60 days, 90 days. You have a long pay cycle. Maybe you're working with one of the big distributors, Amazon's, Walmart's out there. You can actually sell that invoice off typically for about 1.5% on that invoice. So you take 98.5 cents on the dollar, they take $1.50 or for every $100. You can sell that off and instantaneously get cash on that. So yeah, you're giving up 1.5%, or maybe you're saying, holy shit, it's 18%, right? As you try to, we'll get through what these numbers really mean. So as you guys all think, holy shit, that's 18%, just put that in your pocket for a minute. But invoice factoring, again, you have an invoice, you're giving it to a client, the client owes you, right? It's an IOU is what an invoice is, you're taking it off, you're selling it off. Reoccurring revenue financing, which is how we built ours, were for early stage tech and software companies, and allowed them to use collateralize their contract of reoccurring revenue. 12-month agreement, $1,000 a month. That is collateral. We know that Salesforce is going to pay you $1,000 a month for the next 12 months, or go get it from Salesforce. If they don't pay you, we can give you capital right now from a reoccurring revenue. So now that contract still remains your value, your asset in this, and that is what we collateralize. So this is worth something. It's worth, in this case, $12,000. Rob's 401k, who in the room has heard of Rob's 401k? Oh, I like it. There's a couple of guys in here. That's one of my favorite ways to like start up a company at this point, is being able to turn your 401k. Remember that old crappy 401k that you had at your previous employer that you had a couple $1,000 in, or maybe you got tons of money. Maybe it was deferred comp that's sitting out there, and you've invested it in all the Coke and stocks that are out there. You got it in Coca-Cola, you got it in Walmart, whatever, in your mutual fund. Now what Rob's allow you to do, and the easiest simplicity, is to be able to sell off those shares and buy shares in your own organization, moving your 401k money. I always think the $4,000, because I think I have $4,000 in one from when I was like in college. Like, you can take that 401k money and roll it back into your own company, buying your company's own shares of your retirement savings to grow your own company. So before you went out and said, hey, Mr. VC, give me some venture capital, invest your own damn money in it, right? I always say, who am I going to bet on? It's me, honestly, over Coca-Cola or any of these other guys. Like, I'm not looking for your 8% dividend in this, right? I'm doing it for a lot more than that. So why wouldn't I take my 401k money, no penalties, nothing, and buy equity into my own company to inject that cash? You're going to flip over to a C Corp. Yeah. Correct. Yeah, so yeah, you nailed right into it, right? You flip over the company into a C Corp that allows you to be able to buy the shares in your company. It's a little bit down a beaten path. There are, just like SBA, going to be requirements on it, but C Corp is the very first one. Typically, like for us, we work with financial institutions and accounting firms that do it simultaneously, that put the entire package together. But to know it's an option out there for you to explore, ever before you crowdfund or put your tootsies on OnlyFans or go pitch for venture capital, you have this money. You should see how to get it, and it doesn't mean that you should liquidate it and pay taxes on it or early penalties because it's in an IRA account. It's out there. Look at the capital you have. Crowdfunding's easy enough. Credit cards are an interesting one. Why on earth would I ever recommend a company fund with a credit card? There are actually legitimate credit cards out there that will fund early stage companies up to $250,000. Yeah, on a credit card. But remember, oh wait, 18%, holy shit. Just put that back in your pocket for a minute. We're not there yet. So you're not looking for, often what we see in these companies is that they're looking for the big, because you're used to raising venture capital privately, right? Because that's what's hot and sexy, right? Like, I raised $1 million today. No one says, I got a loan for $1 million today. That's not cool and sexy at all. I get it. Like, you don't see that on the front page of the IBJ at all, from anybody raising their hand that they got a loan today. I get it. But there is a time and a place where when you're looking for incremental, you don't need to go to the bank and ask for $1 million. You need to go to the bank or your VC and ask for the least amount of money to get you to the next stage that you need to get to be able to perform just enough to get to the next line, the next customer. You don't have to scale. I need to bring on 40 people. You scare all of us, when you say that. No, but this is what I need. I've got a cybersecurity company. I'm bringing on 2 people and this to be able to fulfill this agreement that gives me a net 20% return on it that will hit in 29 days. It turns into a math equation on, should you really take that credit card at 18% or 25% or factoring at 1.5%? A lot of it, I believe, comes down into a math problem on how you can work through the math and can you cash flow it. Inventory financing, we've talked about a little bit. AP financing, accounts payable financing is a hidden gem in my opinion. It's similar to grants and tax credits. So those next three, right? We know what bootstrapping is. We'll talk on it for a moment, but AP financing, grants, and tax credits. AP financing is your accounts payable, right? It's all your bills that you owe. So now you need $100,000. No one's loaning you $100,000. What you can do is take those invoices that you owe and give them to an AP financer and take $100,000 of financing you need, give it to an AP financer that's writing the credit risk on the person that owes you money, and you've unlocked $100,000. Does that make sense? You have an invoice that you owe somebody. You can go to the bank and ask them for $100,000, and they're not going to give you a loan for $100,000. You can go to VC and go through that rodeo and see what happens. Or you can move through an AP financing company that will finance your AP. So they are actually taking over the debt repayment, the debt obligation. They're going to say they're going to pay your distributor, your whatever. They're going to pay it. And then they're going to bill you very much like a loan, like a bank would do. And you're paying equal installment payments back on that. So instead of paying that $10,000 legal bill, the $5,000 pitch deck, the $20,000 in MacBooks that you needed to onboard your new staff, the whatever it might be, your $15,000 you have to put for an invoice for KSM so you can be SOC 2 certified, or the new servers, you need whatever it is, that invoice can be divvied up to AP financiers, and they will pay that invoice. So where someone wouldn't give you $15,000 or $100,000 loan, there are financiers that will take your bills and finance those back to you and come up with the same, giving you the same liquidity that you would have had if you went and got the straight loan. Following that? You can turn your bills into liquidity. You didn't get straight cash, but instead of you paying $4,000 or like we got a guy right now that, leave him out since we're recorded. You could take that like $14,000 in payables and take those $14,000. His payment is lower on it. His net margin that he makes on his opportunity cost of capital is greater than what he would pay in the interest rate on it. Instead of him paying $14,000 a month, he's paying closer to $4,000 a month, freeing up $10,000 in cash flow a month for him. There's your $20,000. You put it in the smaller manageable payments with a financer that knows exactly, hey, this is the type of financing. The bank's not giving you $100,000, right? VC's gonna jerk you 10% or whatever it is, whatever they want in equity to give you $100,000. And you can do that every single day. Every time you get a bill, you can literally, I say, insert it in and get it financed back to your organization on it. Grants and tax credits, that's the most free money that's out there. Like before you, in my opinion, before you tap dance across stage or anything like that, or sing for supper, do all the things that we said, go spend your 5 hours and figure out what grants. There are free companies out there that will help you get grants and tax credits. Almost any legitimate accounting firm will help you figure out what tax credits you're eligible for. The challenge that we see is that a lot of companies don't spend, and we'll talk a little bit about financials, spend that $5,000 on an accounting firm because their little brother, sister's girlfriend that took one accounting class is their CFO. So you save $5,000, but it costs you $50,000 in tax credits and grants. Because again, your little sister's brother's girlfriend had no idea where the hell to even go to get a tax credit or a grant. But if you're not talking to your accounting firm or an accounting firm, and so a lot of these guys will do it on performance base. If they save you $1, they take 30 to 50% of that buck. They're thinking 30 or 50%. Again, that's 50% more than you had that you didn't know about. There are firms that will do it completely contingent, just on the earnings, and just go get you the tax credit and go get you the grant and tell you exactly where to look. Or you can go spend $5,000 and tap dance across the stage and beg for money. If it were me, I would look for that capital there first and just go find one of the firms. You don't have to figure out where to look. You just got to figure out what firm to talk to. Like, they do all the legwork for you. It is the most free money, and I'm telling you, every single person in this room qualifies for something. I'm 100% certain I can give you that blanket statement that there is free money for everyone in the room in those two categories. And if you haven't gotten that money, you should probably go look at that money. It might be $2,000, it might be 50,000, or your whole R&D tax credit or relocation services, but there's money in there. And then we kind of say the bootstrapping one that I think everybody's familiar with the bootstrapping. Bootstrapping gets, I think, sometimes a bad rap between being cheap and being frugal. Bootstrapping is often putting your capital back into your company so they can get redeployed and not being cheap about things. I often make investments in our company that are very frugal, but they're long-term. It's not a cheap investment that I'm making in the company. Cheap is often referred to in the bootstrapping, and cheap, I think, go a lot. Be frugal. I always say, right, make the eagle scream on the back of a quarter, or make Lincoln scream on a penny, pinch it. And that's how you can turn your company back into and try to preserve some of your revenue or preserve some of your margin, is just by trying to bootstrap that little bit. It's what most people tried to do when they launched their company on it. We just say, hey, it's making frugal decisions, don't make cheap decisions, because those cheap decisions move on. And then the wild card in all of this, I call it the lie detector test in this entire thing. Most of these are going to require a personal guarantee. So before you vomit, that is a lie detector for many lenders. When you start talking to a lender about you not wanting a personal guarantee, you're not going, let me go back to a personal guarantee. That means if your company fails, you are personally obligated to pay that money back. If you won't sign your name, this is my philosophy, if you won't sign your name on that line, why on earth would that institution sign their name on that line? Often it's used as a lie detector. If you're negotiating your PG out of the company as an early stage company, or you're negotiating what your default provisions are, you're kind of negotiating your divorce right out of the gate. And I'm not saying to not be cognizant of that. You should 100% understand what the repercussions are. But I'm telling you, from a direct funder and working with all of ours, all of our funders, PG usually gets to the holdup on it. And I think that that is mirror on the wall. Often the deal that you're getting from that private lender, the bank, the VC, is just a direct reflection of your company. When they look at that PG and you're telling them no back, it's just a direct reflection of your confidence in your ability to execute on the plan and the drag right you did in Microsoft Excel. If you can't swallow that, a lot of these will go away. So if you say you're willing to bet on yourself, right? You're a CEO, you went out on your own, sign your name on the line. That's how you build confidence in these lenders, is that, hey, if this all goes to hell, I'm personally on the hook for this. We know that you're going to try a little bit harder, right? Let's face it, you try a little bit harder. No one's here to take your house and take all your shit and your kid's college fund. That's not what this is about by any means. Stick your name on there. So you've got to, when you go through debt solutions, it's the price you give is the personal guarantee side of it. So I kind of add that in there as off track. Acknowledge that you're likely going to sign a personal guarantee, that if it all goes to hell, if you're not willing to do that, many of these options aren't going to be a path for you now or ever. Even the largest firms, I know Ian works at a big bank here in town, like the largest firms, big companies still sign personal guarantees. I mean, I've owned a few different companies, pretty sizable companies, and they would still make us sign personal guarantees. It was just part of it. You sign it now when you take a loan for $50,000 or accounts receivable for $50,000. You sign it later when you're a $20 million company and they still want you to sign a personal guarantee. That's not going away. You will not outrun the PG boogeyman for a very long time. The moral of the story is you get used to that. Like, that should be the least amount of your uncomfortableness, honestly, in my opinion. You should be focusing on the company. Again, the bank, the institution, the private lender is giving you more capital than your mom probably did. They're rooting for you probably more than your mom is too. Like, I assure you that. And having said all of that, we're not saying equity is a non-starter for you. Often, right? Thank you, Shark Tank 2001. It was all about pitching, giving away your company at astronomical valuations for pennies of value, pennies of dilution. That land doesn't really exist, definitely not in the Midwest on things. There's 1,000% of time and place for equity, VC, especially if you're in the early R&D stage, depending on what your exit plan looks like, including, are you the right person that's going to lead it to that exit? I would love to drag right and say we're going to be a $100 million company one day. I don't know that I'm really the right owner or fit to be running this thing at $100 million. So there's a lot of self-reflection in that of, why do I need an equity partner? Am I just bringing in that equity partner because I need capital, is what you're indirectly saying? Or are you bringing this equity partner because I need their resources to replace my ass when I can't run this at $100 million anymore? Because I'm not there, I'm not savvy enough, whatever it is. But again, it's not an anti-equity. Equity should be, I think, in my opinion, one of the last things you start with. You can never get it back. Debt is always able to be renegotiated. But that's, right, isn't it expensive? You guys all holy shitted when I said 18% or you're gonna give up 40%. Here's a pretty easy one. If you can just roll with basic. You are a early stage company, you're scaling 3% a month. 3% a month. You're signing for 5 years, right? Average venture capital deal, average loan, 5 years, you're scaling at 3%. You're gonna sell the company. I know there's some tech guys in the room, but we're just gonna say for a 4 or 5x. We're gonna try to keep this on earth. I've seen some craziness lately, like beyond craziness on valuations. The beyond crazy valuation just makes this math work that much better. So now your company's scaling at 3%, you're selling the company for a 4 or 5x company, and you have a 5-year term on it. Your 18% that you guys were holy crapping is essentially the 20% interest rate. You can pay 20% interest rate and still have net neutral on the exact same dollar for dollar. That's 20% on your, I see your OnlyFans account, your credit card, your AP financing, your PO financing, your inventory financing. That's just your break even. So if you're only selling, you're only growing at 3% a month, and you're only gonna sell at 4 or 5x in 5 years, there's the math for you. It's just, this doesn't take in the priority rounds. Of course, there's some disclaimers a little bit in here on how valuations and things work on it, but that's how it comes out. It just turns it back into a math equation. If you can cash flow that AP financing or that loan, you can retain 100% of your debt. And what this is, and 100% of your equity. And what it's also not saying is that you never can go outside. Because let's face it, you could do this for early stage, as we talk about kind of the capital stack. I'm gonna, I think I missed it. When we talk on the capital stack side of it, you can use debt as an early solution to increase your valuation before you go out to market, and you're selling at a higher multiple, a higher valuation on it, means less dilution, more money that you take home at the end of the day when you do sell for 4 or 5 or 15x, whatever the magic number might be. Does that make sense? You following that? Right? Every SaaS company says they're going to exit for more than 4 or 5. You got a 5-year plan on it. Here's how the math works out. That's again assuming that you keep that loan the entire time of that entire 5 years. Most of our clients pay it off early because they're able to generate enough cash to just get rid of it and scale themselves out of it. But this is how companies are using debt as a solution in various forms, from inventory financing. They've rolled in their ROB, their 401k. They've done inventory financing. They've done PO financing because you need to hire consultants for the new gig that you just got, or you've got right construction side of it, which typically goes into invoice factoring. Are you willing to give up 1.5% to maintain control of your organization? It's not 1.5% for the rest of your life. It's 1.5% to be able to seize the opportunity in a simple math equation right now. Does this make sense? Can I cash flow it? Can I continue to grow using debt as a vehicle? And I'll end it with, just so that there's no, venture capital is debt, regardless of what anybody says. If you're repaying something back to someone, you are indebted. That's just basic definition. Anybody that ever says venture capital is not debt, you should probably walk away from. You point them to me. Venture capital 100% is debt. It needs repaid. It has a future further obligation in it. So it should be looked at when people say, hey, all debt is bad. I just showed you that you can pay 20%. It's not bad. I'm not an advocate of saying you should, there's where the sky is on it. I mean, there's times that you might take 50% APR capital, and you're thinking 50% APR, When on earth would I need it? Well, when your opportunity costs are that much greater than that, it turns back into a math equation on when should you take the capital, when shouldn't you take the capital. Just because it's an 18% credit card doesn't mean it's the wrong thing for your organization. Here's two examples that we did. Swing Logic, awesome company. You can buy their product online, golf simulators. They make the club. They got, I say the holy grail, they got a contract from Walmart and Sam's, right? Like what every early stage company wants. I got the holy grail contract. What you don't know is you got to buy your stuff to be able to stock it on their shelves. They don't really give you financing for that. You got to produce the product to be able to get it on their shelves so that they would be able to stock it. So they grew. We did the first 2,000, I think, order with those guys. 2,000 units, we brought it in. They needed inventory financing. They would have went to a bank, which they did, and the bank said no. They don't need a loan for $560,000. They need inventory financing for a niche business, a tech company that has a hardware component, which now you've removed that many more institutions out of it. So you have a tech product, hardware component. A lot of VCs aren't the most fond of that. Banks aren't real fond of it, and you're a startup with not a lot of revenue. They're not going to give you $560,000. What we were able to do is provide them with a tiered structure based on their orders so that they could bring in, they could import the golf stick simulators from Hong Kong, I believe, into the country. Once it got on the ground and in the States, using Intrepid. Like, this isn't anything you guys got to figure out on your own. That's what Intrepid Tech and our partners at Rams Head Funding on the servicing side do. We're able to flip them from inventory financing to PO financing. That PO financing turned into an inventory. That inventory ended up selling their product into Walmart, landing them 20,000 additional units. So they went from 0 sales, 0 orders, 0 anything, and turned a piece of paper into a 20,000 unit order with Walmart without any venture capital. No venture capital, no credit card, none of his money put into it. But that's how he was able to steer, put his capital stack together to come up with the $560,000 so that he could bring in and import his product and be able to provide to Walmart. Otherwise, right, you got the holy grail, but you couldn't produce, which is often what companies do. And it goes all the way back to the offense or defense, right? He's doing that as an offensive mood. He says, okay, what is my opportunity cost? If I lose this, what is my long-term lifetime value of this agreement? How much margin can I give up? If it says I can cash flow this, and if it's less expensive, pass go and collect $200. In this case, 20,000 units with Walmart. Since then, he has outgrown that credit facility and he's moved completely into SBA. 0 revenue, no customers, holy grail piece of paper, international product, software company and hardware company. These are all the things everybody does not like about a company. Rolled all the way from 2,000 units to 20,000 units, 20,000 units, from a tiered credit stack into a true SBA loan with a bank institution. I'm certain he appreciates not being on the streets because he was trying to get that filled for like 6 to 12 months prior as he pitched across stage and tried to get VC firms and everybody else to get it, and they didn't like that piece of it. And then this one's actually a recent deal that we did. STS is a tech company, and they provide everything tech support, cybersecurity. Kind of think of it as the on-call for small and mid-sized companies. Same thing, lands his agreement and needs to add additional staff so that he can fulfill the agreement. Specifically looking at you, Chris, on that, like he needs to add staff to fulfill his agreement as a cybersecurity and tech company to roll out his services. He has the agreement, but he doesn't have the revenue. Nobody wants to give him the capital because of it. We come in and we give him the capital on it because that piece of paper is an asset. Remember that, right? The PO, the Walmart order, that is an asset. It's worth money. And he was able to take that agreement, bring it over, and then we were able to provide him with funding based on that agreement, saying, here's the funding. This provides you with enough capital to onboard your staff, allow you to have the 60 to 90 days that you need to be able to bankroll those guys while you get up and rolling with the institution that you sign this agreement, because if you get to point X, we know that point Z is coming and they're going to do the repayment side of it. Here's how a company was able to move through us, get that funding, and since then he's gotten, I think, about a $50,000 or $60,000 loan through traditional banking. just trying to get them that little bridge, that little mezz. You don't need $1 million. You're pitching across stage for $1 million. You need just enough to get that next deal. Just get your next customer, your next contract, your next revenue, and all of this starts to come together. And kind of throw into best practices. Like I said, we saw $950 million in deal flow. Most of them lose because of these things. Clear financials, remember what I said, your little brother, sister's, girlfriend's, niece that took one accounting course is not your accountant. You're doing yourself a complete disservice with that. I'm not saying you got to go buy one of the bigs, but have someone that knows what the hell you're doing, because when a lender looks at your financials, if they're not organized, they're not in order, there's errors in it. Now you're already kind of guilty until proven innocent, just being transparent. Now, when we start finding errors in your financials, deposits, they can even be positive things. Deposits that came through your bank statements that didn't show up, that didn't hit on your financials that don't reconcile with your bank statements on it. As we find those errors, it becomes that much more difficult for a lender to believe your story, your passion, your everything. But remember, you saved $1,000 by using your brother's little girlfriend, sister, whatever, right? So if there's an investment to be made, have clean financials. Know what the hell they should look like. Someone that's scrubbed them. Because remember, that $1,000, $2,000 or whatever could have bought you the first 15 pages of your boring pitch slide that you created that's not going to get you any capital. You could have used that $2,000 to clean up your financials, to become banking and financial eligible. But also remember, finding those tax credits and grants should offset the bill you just paid these guys. They should find that for you. It's the free money. You spent your $2,000, you found 10 grand. You got better prepared that you can walk into an Everwise bank and say, hey, listen, I know what I'm doing here today. Here's clean financial side of it. To maintain the clear, organized documentation, it's an interview process. The entire thing is an interview, in my opinion. From the moment you send your application over and you write in all caps lock or lowercase, you think it doesn't, all those things just kind of add up and irritate an underwriter. Like, just do clean documentation, clean documents. 100% don't ever modify a document in any way, especially any bank finance statement, no matter how minor, bless you, or minuscule it is an automatic decline with about 99% of our lenders out there. Know your forecasts and numbers. I always say that's kind of like the second lie detector. Like, remember when we went back to the personal guarantee side of it, like that's one of the lie detectors. Your forecast, when you start dragging right, as I say in Excel, everybody starts dragging right. I've got a $750 million total addressable market, and I have no incremental cost for bringing in additional labor or anything like that. It's going to scale. Really, you're kind of saying a pipe dream, and your whole thing starts falling apart. It becomes less attractive than if you were to just kind of tell the truth or be in that modest line of conservativeness. Remember, the underwriter, whoever's reading your file, has probably seen a very similar file 5,000 other times and seen where the boogeyman comes out of those. So we always say, hey, make sure they're believable numbers, 100% believable. You're trying to make these guys feel comfortable. You're not trying to show them that you're trying to get to the outer space. Remember, these are debt providers, they're not venture providers. They're not trying to get you to hit the moon. They're trying to get you to do loan repayment and then put you in the orbit, at least get you into the atmosphere side of it. They don't want you to blow up blowing through the atmosphere, which most companies do if they take VC. And for us, like I said, I'm 100% certain we would have blown up going through the atmosphere. Had I have taken VC money, I would have just skyrocketed that much faster in the wrong direction. Clear funds and use of story. I always say, hey, do the math for them. Like, here's, as I kind of said, do the math for them. Here's why I need it. Here's how the math works out. Here's how it's going to do. Here's how I'm going to take this money back. Here's how I can do the debt service. I can afford it. Here's what my margins are. You articulating that plan, or your non-girlfriend's little brother, sister, accountant, has put that together, that you clearly understand how you're going to do debt repayment, and you've thought through the contingencies of, if this goes wrong, here's what's going to happen. And you've kind of thought through that. If you just go in there pipe dream, nothing ever is going to go wrong in it. You're just, again, putting one more, let's say, hash mark on the left-hand side of, I'm not sure that I really want to do it. Prepare example agreements, especially, as I say, that piece of paper it's an asset. Make sure it looks like an asset. It doesn't need to be written by the best attorney out there, but it needs to be a strong standing agreement that they're committing to pay you. You know, you don't have any nonsense in there. There's not taking equity ownership in your company on anything. That contract is what you're technically selling. So the stronger that contract, if you're saying, hey, this is a 1-year contract, which often happens, but you have a 30-day out notice at any time, that's called a 30-day contract. If they're not committing to 12 months of marriage with you, that's a 12-month contract. If they're committing to 12-month marriage, but they have an out every 30 days, that is a 30-day agreement. That's much more difficult. So it's easier to position your agreements in place today so that when you sign a 12-month agreement, it's 12 months of revenue. It's not 30 days of revenue. That's a different type of contract sale. And I say building the relationships when you need them. That's not just in VC, right? That's in every market, but we say this on the debt side of things. Understanding your debt position and what you're available for right now, including nothing, is very valuable. Literally just, I hate this, but Rams had our servicing partner on the spot. Literally just filling out an application just to see what you're eligible for, what they like and don't like, I believe has a lot of value in it. They're going to tell you about that clause in your agreement that they're not going to like, or that you getting paid in full by 25 different school systems might look really attractive, and it's not really that attractive to us. You know, that you might have a municipal contract or a government agreement, but the way it's written, we don't like that. So as you're an early stage company, you might not be dying to go out and try to raise $1 million right now, or might not need any capital right now. I can always say, hey, it doesn't cost you anything than a little bit of time to just see what the things are that you need to do to prepare yourself for that when you do go out for capital, that you know right out of the gate, I already have access to $20,000 or $50,000 or $100,000. Or these are the things that they didn't like about me. Because if a VC told you that, you would go do it, right? Like, hey, you need more X, Y, and Z, you would run out and go do it. If a bank says, hey, these are the things I don't like about your company, but if you tweak this agreement, you tweak this revenue or this, it would change these ratios, we'd be more willing to do it. It's so crazy, people like don't do it. If a VC tells you at the crazy ass dilution number, you do it. When the bank tells you, trying to give you the institutional capital that you're probably dying for, that is the best, some of the best capital out there on that institution side, people don't follow it. So why not just do that exploration, that kind of test right now to say, what would I be eligible for? What are the things that they like about my company to move me in the VC, and to get your mind shifting out of private equity is my only option, or VC is my only option, and moving your mind into, hey, there is this whole other avenue out there, from PO financing, the inventory financing, the contract, the AP financing, that will open up money. What would I even be eligible for today? So that you can, again, focus on what you do best, and that's kind of the growth side of it. Back one more. Kind of through the founder framework together, that bottom base is really right. Your kind of your basement side of it is, what is the product or service that I really need for this stage that I am currently in? And just because you're angel or pre-revenue or just launching doesn't mean that it's only angel or venture capital or credit cards or crowdfunding or your mom, right? We can cross all of those off, even though you're pre-revenue, brand new company, because there are other ways that you can get access to capital, even outside of, say, that early stage bottom tier. Then moving up into the leverage of the non-dilutive options, debt, and the creative capital tools. That's where companies like Rams had come into play with us, that they work to put a capital stack together. So you might need, again, $300,000. You take $100,000 as working capital, $150,000 as inventory financing, and $50,000 for your new MacBooks for your 5 new employees you just hired, so that you can onboard your brand new client. Same capital, same money, same allocation, 3 different providers that will stand in priority positions behind each other that provide you with the exact capital that you need without tripping any covenants to give you the exact capital that you already need. And then at the top of it, maintain the ownership on the dilution side. So if you want to go out at that point, you've raised your valuation to a point that you want to go outside and get additional capital, you can go still do that VC or that equity raise. We have a company in town, early stage tech company. I'm sure most of you guys know it. They paid us about $1 million in fees, interest. Now, over the course of some years, $1 million, that's a real number in fees. He was able to raise his valuation $20 million on that $1 million in fees. And then he went and did his raise. And he's like, that was the best $1 million I've ever spent in my entire life because I kept 95 and you took 5. I'll call that a deal any day of the week. And if you can't see that side of the deal, right, you got caught up in, 20%, you know? You got caught up in that. And here's a guy that literally just did it in town, running for a Mirror Award, that took $1 million in APR fees and raised his company valuation $20 million to get a higher valuation, pay us back, and he's off to the sun. That's how you can start leveraging debt. And even if you want to go outside and get private equity or venture capital, then just try to raise your valuation. Even if it's $5,000 you get, you can raise your valuation and still go outside for outside capital on that standpoint. That's me. If you want to connect with us, there's my number on there, email address, website. Connect with me on LinkedIn. Happy to be a resource. I know I've spoken to some of the different groups in here, some of the different groups before, but if we can help you in any way, it costs you nothing other than your time. There's no fee, there's nothing whatsoever, like there's no hiddenness. We make our money by the institutions on the back end. We don't spray and pray your files out there. Gavin and his team at Ram's Head really try to say, okay, where is it? What are your options at this point? And how could you get from point A to point B? It might be credit card is your only option. This is your best options. We're not saying you should take it or not, but here's where you are, but here's how you get to the next servicing product. Here's how you get there. And if you just focus on moving 1 inch forward at a time, you're not trying to hit the moon with your $1 million raise because it's sexy on the front page of the IBJ. You know, what really sexy is your results, your performance as a company. So just keep inching it forward. And that's where his company will work with you to be able to keep inching you forward to say, we're getting you into PO financing or factoring or getting you ROBS is the best way for you to convert your company. So that's the end of the spiel. Tried to go as fast as I could. Yeah, questions? What questions do you guys have?
Oh, okay. You want me to start off? Yes. So in this example with Superior Technical Solutions, you noted that it took 7 days from start to finish. What is the standard time? And the reason I ask is in the examples you gave, if you are looking for funding based off of an invoice or a future customer order, a lot of times speed is important, meaning you get the order from Sam's or Walmart, you now have to still go buy the equipment, produce the equipment, and then deliver what you need to. So what is just a typical time frame when I know speed is of the essence a lot of time? Or maybe you do it before you get the order, which then kind of makes it difficult to get the financing you need. So I think that was the part I had the question on.
Yeah, kind of the chicken or the egg side. What I'm also hearing you say is that line up here in the defense, the offense, you're about to straddle this line and you don't even see it. And that line is you're now chasing capital quickly. As soon as you throw fast or quick in there, it's a great indicator that it's probably offensive or defensive capital and not offense. We think we're playing offense, right? We're going to get capital to place this order, right? So step back and say, okay, and that's why I say, hey, go see what your options are for capital right now. You don't have the chicken, you don't have the egg, just see what your option is right now. Now you have that invoice. The faster you need to move, the more the premium is, all right? You can go in the checking the cash and hemorrhage your brains out if you want. We can go to the New York Mafia and get money real quick. A typical deal if you have a client if you're getting set up with them, typically you're in that 2 to 3 weeks. I say the longest period is usually waiting on you. It's that you didn't provide something, there is a question on something, it's you. They only make money by lending you money out. They want to lend it as fast as they can. They're not going to be reckless on it. I would love to say, hey, it's a week, 2 weeks. It depends on the dollar amounts and things like that. We've moved some pretty big deals through the company fast, but you should give yourself 2 or 3 weeks to do a good job, a diligent job of finding the right provider. Because again, when you work with companies like Ram's Head, they're probably going to bring you 2 or 3 providers at the same time. Most people choose the lowest rate. They didn't read the 50 pages of terms and conditions that married them for life. Like, so we're trying to walk you through that. By setting up early with a company, what you're doing is that you're setting up early with a provider and understanding who are the providers that would write my business and what does that business need to look like before I go get a deal and then try to cram it down an institution to get them to do it. Because that's kind of what you're doing, right? If we understand your business, and that's part of that, I say that application process, then we know what partner to go with, what type of financing you're most likely to do. And that will dramatically bring down that 3 weeks into a week and a half because you already have that relationship. They already know what's going on with your agreement, even though you've never done any business with them. That's where the starting early is, but that's how you can flip into from a defense into or offense. You think you're doing it and you go into defensive mode. You took that quick capital loan that you might not ever be able to easily get out of. SBA is not going to refinance that out. It's probably at predatory rates. The next time you get growth, the only option is you have to go back to maybe one of these merchant cash advance options. They're sucking your margin even more out of you. And it's all because you did the bad deal the first time. And that's what we really are trying to prevent is taking stupid money on the first go. Any other questions on anything? I know I went through a lot. Again, offer myself as a service to you. I've scaled different companies. I see just about everything. We've seen lots of wonky and craziness. We've done some really creative capital stacks for companies, including in bringing in private equity. We have a new accounting firm that's coming on us that will instantaneously tell a company what tax incentives they're eligible for based on their financials and their previous taxes, to just kind of make it blatantly easy. We have our servicing side, Rams Head Funding. They're local in town. Gavin and his team have been in banking for probably longer than I have. On the banking side, to help you put a capital stack together to understand your unique situation on what lenders would look for to be able to fund your deal. When we talk lenders, we're not talking just the BMO banks and Chase banks and all these guys out there. Nothing against those guys. We're taking it, and we work with both of those. We're taking it to the exact provider that understands your industry, your service, your product, your revenue, and where you're at right now to provide you with the funding. So hopefully it was helpful. I appreciate you guys coming out. I commend every one of you guys for your launch and starting up your companies and going through it. As easy as I make it sound that we do this, trust me, I've gotten punched in the face a lot along the way. So fortunately, I didn't take capital to get punched in the face any faster because I don't think I could have taken any more. But appreciate everybody coming out today.